In this video, we teach you a simple option strategy with an incredibly high win rate that is both easy to learn and easy to trade. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And if you've been trading for a while, you'll know that the most frustrating and discouraging thing about trading is that whether you like it or not, you're going to lose a certain number of your trades. And that's just part of trading and fact of life. And no matter how disciplined you are, there's always a feeling of regret and disappointment when you lose. And for most day and swing traders, losing 40, 50, or even 60% of your trades is kind of normal. And working with traders all over the world, we hear about this frustration a lot. And so if there was a trading strategy that was statistically structured so that you'll on average win about 80% of the time, would that be something you'd like to know more about? And what if that strategy didn't require you to decide whether you were bullish or bearish? A strategy where you didn't need to predict any direction at all? Well, there is such a strategy, and in this video, we're going to be teaching it to you. So you'll want to stick around if you get frustrated, like everybody else does, about constantly losing trades. Now, if you're absolutely brand new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand this very easy option strategy that you can trade each month. Then when you're finished, you can come back and watch the rest of this video. As I was saying earlier, there's a strategy using options which not only doesn't require you to decide whether you're bullish or bearish, but also has a statistical win rate of about 80%. And the best way to teach this strategy to you, which is a 60-day strategy, so you put the trade on about 6 times a year, the best way to teach it to you is to go back to the beginning of last year, 2022. And as you can see, the S&P 500 index, which trades under the symbol SPX, staged an impressive rally in 2021. It was up 27% that year and started the new year with yet another rally opening at 47.8889 on the first trading day of the year. And so let's suppose that on that morning, you pulled up an options chain expiring on the last trading day of February 2022, which was the 28th. And if you'll notice, that options chain has a column called delta. Well, the delta of an option is based on a mathematical formula which predicts how much the price of that option is going to move based on how much the index moves. And we don't have the time to get into the details of how that works right now, but for the purposes of today's lesson, suffice it to say that an options delta is highly correlated to the probability that that option will have any value at all on the day that it expires. So for instance, let's take a look at the 50-50 call option that we've highlighted on this slide. And you can see that the options market is saying that the 50-50 call option has only a 10.77% chance of expiring with any value at all on February 28th, and therefore an 89.23% chance of expiring with no value on that day. And the way a call option expires worthless is if the index closes below its strike price on the day that the option expires at the end of February in this case. So if it has a 10.77% chance of expiring with some value, then logically it's also telling us that the SPX index has an 89.23% chance of expiring below 50-50 when it expires in 60 days, which makes sense because the index is trading at 47.88, and so rallying to 50-50, almost 300 points in 2 months seems somewhat unlikely. And so that delta of 10.77% makes sense. Okay, so with that in mind, let's suppose that on that day, you went ahead and sold 10 of those 50-50 calls, expiring in about 2 months on February 28th, for that price of $10.20, and bought simultaneously 10 of those 50-60 calls, 10 points above that one, for protection and paid a price of $9.20. And at the exact same time, he goes down to the puts to to the 4260 puts, and he notices that those have a delta of 10.11%. And in the case of puts, what that means is that the 4260 puts have a 10.11% chance of expiring with value. And therefore, like we discussed in the case of the calls, it has an 89.89% chance of expiring worthless also. So he sells 10 of those for $22.90 and buys, for protection, 10 of the 4250 puts for a price of $22.30. Well, when a trader does that, selling a call and then buying another call on the same options chain above the one he sold, plus selling a put on an options chain and buying a put lower down on that same options chain, when a trader does that, he is entering into what options traders refer to as an iron condor. Now, let's break down the cash flow of this trade so you'll understand how it works. And so starting with the call side, we were paid a price of $10.20 for those calls. But remember, each call option pays off at a rate of $100 per point that the index expires above 50/50 on expiration day. And so you multiply that by 100 and you sold 10 of them. And so when you multiply it all together, you'll get cash inflow of $10,200. And using that same math, you end up spending $9,200 buying the 50/60 calls for protection. And then moving down to the put side, you sell the 4260 puts, receiving $22,900 in cash inflow, but you spend most of that, $22,300, for the protective 4250 puts. So when you net it all down, you end up with $1,600 in positive cash flow that goes right into your account, for which your broker, by the way, will require $8,400, which is the worst case scenario on the trade. Let's now move to the day this iron condor expires on February 28th. And as you can see, the index had started the year by selling off, shedding more than 400 points and closing at 43.7394 on the day the options expired. And so let's analyze how our trade has turned out, because once options expire, they can be assigned a final value. And as you can see, that's going to be a pretty straightforward exercise, starting with the initial cash we received, so that $1,600. And after that, it's zeros. And let's see why. Well, the 50/50 calls we sold and the 50/60 calls we bought, the index closed way below those calls. So those both had no value. But on the other hand, the index closed more than 100 points above the 4260 calls we sold and the 4250 puts we bought, resulting in all four options having no value on expiration day. And therefore, and this is a crucial point, you get to keep that entire $1,600 you received initially. In other words, it was a good thing that all of your options expired, because then you just get to pocket the cash flow. Whereas if the index had closed above the 50/50 calls we sold or below the 4260 puts we sold, we would have had to make a payout under those of $100 per point per contract. So that means all of those contracts expiring worthless is actually the goal of an iron condor. And as long as the index closes inside the range between the short calls and the short puts, you win all of the cash flow. So the best way to understand an iron condor is to remember this one simple concept. If the index closes between the prices of all the calls and all the put positions, the entire iron condor expires worthless and you win the cash flow. So let's move to the next trade, which will open up the next day, where the index opened down slightly at 43.6819. And so in this case, the 10 delta calls are the 47.90s and the 10 delta puts are the 36.50s. And so again, we sell 10 of the 10 delta calls at 47.90 and buy 10 of the calls above those. And we sell 10 of the 10 delta puts at 36.50 and buy 10 of the puts 10 points below those at 36.40. And so assessing the cash flow of this new trade, you can see that netting down all of the cash inflow and outflow from this second iron condor, in this case, results in net cash inflow of $1,750. And again, moving to the day this iron condor expires, we can see that the SPX index continued to sell off into late April, closing at 41.3193 on the day the second iron condor expired. And as you can see, again, after accounting for that initial cash flow, all of the options again expired worthless, resulting in a straight win, again, of the initially collected $1,750. And so we continued like this through the final 8 months of 2022, opening up an iron condor 2 months out from when the options of that condor expire, with short calls and short puts at 10 deltas and long calls and long puts, respectively, 10 points further from the market for protection. And so rather than run through each one, which would be a little repetitive, we created this table for you. And so having reviewed the January, February, and the March and April trades already, you can see that the May, June condor had short calls at 45.70 and short puts at 33.90, and the market closed far away from both positions, and so that trade was a full $1,900 win. The July-August trading range was 3,200 to 4,230, 1,000 points wide. And so with the index closing at 39.55 at the end of August, all of the calls and puts expired worthless, creating a $1,750 win. The September-October trades range was 33.80 to 43.40, also about 1,000 points wide, and the index closed at 38.71, well within that range. And as you can see, the November-December trade was similar, with a very similar outcome as well. And so, kind of remarkably, because this actually isn't normal, all 6 trades ended up being winners for 2022, resulting in a total gain of $10,750. And the most capital that was ever needed was actually for that January trade, which was $8,400 in that case, resulting in a very conservatively stated 127% return in 12 months. It's important for you to know that this is not normal, that if you do this year after year, the results should come in much closer to an 80% win rate, as we mentioned in the beginning of the video. And so you may be wondering why we keep saying that we expect an 80% win rate. Well, think about it. If 10% of the time the short puts will have value at the end of the trade, and 10% of the time the short calls will have value, well, then that means that if either the short puts or the short calls have value, then you're going to have to make a payout to the trader you sold those puts or calls to. And that payout is coming out of your pocket and most likely will create a loss for the trade. In other words, with a big enough up move or a big enough down move, you'll lose this trade. And if your short puts or short calls are located at 10 delta, there's a 10% chance that that's going to happen on the downside or the upside. So you have to subtract from a 100% win rate the fact that 10% of the time a sell-off is going to cause a loss, and subtract from that 10% of the time a rally is going to cause a loss on the call side, because either of those could happen. So they reduce the probability of the trade by 10% for the downside, the put side, and 10% for the upside, the call side, resulting in an 80% net probability of profit on the trade. Okay, so before we wrap up, I do want to cover one more important topic, and that is that there will be occasions when you'll get nervous and fear that you may lose the trade because the market is making a strong move to the downside or the upside. So in these cases, are you just stuck losing the trade with no remedy? And the answer is not at all. There's a fix to the iron condor trade which will frequently work, and that is known as rolling the trade. So for example, let's take a look at the SPX index on October 13th. And as you can see, there was a significant sell-off during the September-October trade, and at one point the index got as low as 34.91. And so when there is a big market move like that, it inevitably puts one of the sides of the iron condor under stress, meaning that there might be a legitimate chance that the market could reach the side that the market is moving towards, in which case you'll have to make a payout under the short puts or the short calls that you sold, which would cause a loss, as we said, in most cases. And so what some iron condors traders like to do is to move the position that is in danger and roll that position away from trouble. So for example, on October 13th, with the SPX trading at 35.53, if you look at the delta of the short puts down at 33.80, you'll see that those have now exceeded 20, which for certain traders is a kind of line in the sand, because it means that if that side of the trade had an initial 10% chance of creating a loss, but now the probability of that danger has moved to 20%, then that doubling of the probability of a problem becomes a point of action for some traders. And so what many options traders will do at this point is to close the original position, buying back the 3380 puts and selling off the 3370 puts, and just pick up and move them down to a strike price where the short puts will again be restored to 10 deltas. And in this case, that means the trader would move the entire put position down such that he'd sell 10 of the 3250 puts, which have a delta of 10, and he'd buy 10 of the protective puts lower, like he always does. So he'd be buying the 3240s. Now, this move comes at a cost. And in this case, the cost is $1,150, which if you look at the pricing on the slide, you can verify for yourself. And so as we mentioned earlier, on the day that this iron condor expired, the SPX index had closed at 3871.98. And so since the new iron condor has the original call position of 4340, 4350, that one didn't move, but the put side has moved down to 3250, 3240, then you can readily see that all the options expire worthless. So then, calculating the final win on that trade, we again start out with the initial amount collected, which was $1,800 in this case. But then, and this is important, we've got to deduct the cost of the roll, which was $1,150 as we mentioned. And then, of course, you factor in the value of the expiring options, which are zero, because the index closed between the calls and puts. And so in this case, we made only $650, and the culprit of that lower profit amount was the roll. And so the lesson from that rolled September-October trade is that there's a cost to risk management and safety in trading. Rolling those puts out of harm's way had a cost, and that's going to reduce your profits on a trade in any particular trade. But in the long run, applying sound risk management techniques to your trades is always going to be the right decision. So what I'd like you to take away from today's video is that there is a way, on a relatively modest amount of capital, to conduct a campaign of trades which have a statistical 80% likelihood of winning, which is an extraordinary win rate compared to pretty much any other form of trading. And in some years, like 2022, the returns can be unbelievable, as we demonstrated in this case. And at the same time, there are sound, time-tested risk management techniques that can reduce your risk of losing even further, with a cost that in the long term is going to be worth it to you, because in trading, it's always going to pay off in the long run to manage your risk carefully, even if it takes a reasonably small bite out of your long-term profits, like rolling the September-October condor did. That's the way that consistently successful long-term professional traders think, and I strongly recommend that you think that way as well if you want to be a successful trader.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.